In Australia, brokers are constantly lowering fees, offering sign-up bonuses and rolling out new features. But before you jump on the next shiny offer, ask yourself one key question. Is this a CHESS-sponsored or custodial broker? That one detail has flow-on effects. How secure your investments are, what tax time look like, and how much control you really have. In this video, I'll break it all down, and at the end, I'll share my personal approach and explain why I've chosen the way I invest today. Let's get started. In Australia, when you buy ASX-listed investments, such as shares or ETFs, they are either held under CHESS-sponsored model or custodial model. CHESS stands for the Clearinghouse Electronic Sub-Register System. If you're using a CHESS-sponsored broker, your investments are held in your name, recorded directly on the official ASX settlement system. You're issued a holder identification number or HIN directly by the ASX. It's a unique 11-digit number, starts with the letter X, followed by 10 numbers. Every share or ETF you own with a specific broker sits under one HIN. If you use multiple CHESS-sponsored brokers like I am, you could have multiple HINs, one for each broker. Picture the ASX as a secure vault, lined with drawers. Each drawer is labeled with a unique HIN. Find the drawer with your HIN number on it. Inside the drawer are little treasure boxes, each one holding a specific share or ETF you own, along with the complete record of every trade you've made. The drawer and all the treasures inside belong entirely to you. Your CHESS-sponsored broker doesn't own the drawer or the treasures inside. They act like a trusted butler, managing it on your behalf. In CHESS terms, they are called your sponsor. They are formally authorized to access your HIN, place trades, and update your details when you instruct them through your brokerage account. With custodial brokers, things are a bit different. Your broker, or specifically their custodian, holds the investments on your behalf, meaning they are the legal owner on record and you are the beneficial owner. You don't get your own HIN from the ASX. Your custodial broker has one single HIN that covers all the investors using their platform. Think of it as one giant drawer in the ASX vault that belongs to the custodian, holding not just your treasures, but everyone else too. You don't own or have direct access to that drawer or what's inside. Instead, your broker keeps internal records to track which portion belongs to you. It's worth noting that the CHESS system is unique to the ASX. If you are buying investments listed on overseas exchange, the custodial model is the only option, even if you are using a CHESS-sponsored broker for your Australian-based investments. Now, who owns the investment isn't just a technical detail. It shapes 5 differences between the two models: investor protection, tax time experience, transparency, portability, and fees. If your CHESS-sponsored broker goes bust, your investments are still in your name. They are visible on the ASX under your HIN and can be easily transferred to another broker. But with a custodial broker, your investments are not held in your name. They are part of a pooled account. If something goes wrong with your broker or custodian, your access could be delayed or in some extreme cases, tied up in legal processes. In Australia, outright loss of investments due to custodian failure is rare, but not just a theoretical risk. Over the past decades, cases like Halifax Investment Services and BBY Limited have shown that when things go wrong, investors can face years of delays, legal uncertainty, or even partial loss of assets. These incidents highlight that while the probability is low, the consequences could be significant. Paying tax is an unavoidable part of investing. For Australian investors, tax generally applies in 2 areas: on dividends or distributions received during the financial year, and on capital gains when investments are sold for a profit. With CHESS-sponsored brokers, you are the registered holders, so share registries will provide dividend and distribution statements directly for each company or ETF you invest in. If you have provided your tax phone number, some of that income is usually pre-filled on your ATO tax return. But when it comes to capital gains, there is no report from your broker or the share registry. You or your accountant need to calculate those yourself using your buy and sell history, either manually using a spreadsheet or by using a portfolio tracker like Sharesight or Navexa. Many investors choose to reinvest dividends or dollar cost average into the same share or ETF over time, which creates multiple purchase parcels. If you sell a portion of your holding at different points in time in the future, it can be quite difficult to work out which parcel was sold and which are left. This makes calculating the correct capital gain very challenging. For ETF investors, there is another lesser-known challenge: the need to adjust your cost base each year according to your AMAA statement. I have done a dedicated video on that, so check it out if you're interested. Without a portfolio tracking tool like Sharesight or Navexa, keeping on top of all this can quickly become very messy and overwhelming. With custodial brokers, things are more centralized. They typically issue a consolidated annual tax report summarizing all of your investment income. Some even provide a capital gains tax report. However, there are two caveats. First, this platform generally don't feed data into the ATO's pre-fill system, so you will need to manually enter those figures. Second, the GST reports almost always assume first in, first out for parcel selection. If you want to use another method like last in, first out, minimize gain, maximize loss, or even manual parcel selection, you will need to recalculate your capital gains yourself and not rely on those reports. And like discussed earlier, if you have built multiple parcels of the same investment over time, if you want to optimize your capital gains tax calculation, it's almost essential to use a portfolio tracking tool. I'll be doing a video on this topic very soon, so stay tuned. Whether you're using a CHESS-sponsored broker or custodial broker, you generally have access to your trade confirmation and transaction history. CHESS-sponsored brokers give you direct access to company communications, like invitations to annual general meetings, options for dividend reinvestment plans, and voting rights. You are treated as a shareholder. If you receive dividends or distributions, they are also paid directly to your nominated bank account. With custodial holdings, all of that goes through your broker. You are relying on them to pass messages on, and not all custodial brokers offer full corporate action support, especially for small holders. Since you are not the legal owner, dividends and distributions are first paid to the custodian's account. The broker then credits those payments to your in-platform wallet, and from there you can choose to withdraw the funds to your own bank account. One of the big advantages with CHESS-sponsored broker is portability. If you ever want to switch brokers, moving your investments is generally easy. Most platforms accept incoming HIN transfers at no cost, and the process is standardized across the industry. Just be sure to check if your current broker charges any fees for transferring out. On the other hand, transferring investments held under a custodial model isn't as straightforward. Since your holdings are recorded internally by the broker, not directly on the ASX, there is no standardized process. Compatibility between internal systems can vary, and whether a transfer is even possible depends on both the outgoing and incoming broker's policy, so it's important to read the fine print before signing up or switching. This used to be a big argument for custodial platforms. They were cheaper. Because custodial brokers can pool all investors under a single HIN, that can reduce their back-end costs and pass those cost savings on in the form of lower brokerage fees. But the gap is shrinking. Many CHESS-sponsored brokers now offer trades as low as $3 or even $0 for small parcels. The cost difference is no longer as big as it once was. In my next video, I'll compare some low-cost CHESS-sponsored brokers for long-term passive investors, especially if you are participating in dividend reinvestment and dollar cost averaging. Stay tuned. Here is my view. Yes, custodial brokers are improving. They made investing more accessible through features like automated investing, sleek mobile platforms, and handy consolidated tax reporting, especially useful for newer investors. But for me, the difference in cost is minimal now. I invest long-term, I dollar cost average, I reinvest dividends and distributions over decades and maybe even passing wealth onto the next generation. So I'd rather remove that extra layer of counterparty risk. Even if it's a 0.1% chance something goes wrong, nothing is too big to fail over a very long time. And because I use a portfolio tracker, information from different registries and reports are no longer overwhelming. It pulls together all the granular but transparent data and presents it in a consolidated view that's easy to manage. I don't need to rely on a custodian to give me my data in a tidy report. I already got the tool to stay in control. So yes, chess does matter, at least for me. And if you're investing for the long haul, it's worth understanding why it might matter for you too. If you're wondering which chat-sponsored broker is right for you, check out this video. I compare some of the best low-cost options for Australians in 2025. Thanks for watching. I'll see you over there.